Friends, welcome back to our channel OMSAI Bhojanapalli.
Morning friends. Please settle down. So in the previous class we are doing the problems relating to capital asset pricing model. Today we will be continuing and completing the first slot. Then we will discuss a concept called as portfolio beta, a very small concept only, and we will also do some number of problems in portfolio beta. If we have time today, we will have an introduction to the concept called as levered beta, unlevered beta and proxy beta. But today let us first try to complete other problems in CAPM as well as the concept of portfolio beta. Now please settle down. Now let us see what has been done in this chapter till now before we proceed further. To value an asset, we require a discount rate. Please stop talking. Because value of an asset is nothing but present value of the future benefits discounted at the required rate of return. So for valuation we require a discount rate. Discount rate in turn depends on the risk of the asset. When I say risk of the asset, how certain is the benefit is only we call as risk of the asset. So we need to know two things: how to measure a risk, and number two, what return one should ask for a given level of risk taken. These are the two main issues we try to assess in this chapter, portfolio theories. We said we will be discussing this chapter in 6 segments: risk return profile, Markowitz portfolio theory, capital asset pricing model, then the arbitrage pricing theory, sharp single index model and efficient market hypothesis, in which we completed risk return profile, Markowitz, and we are in the process of doing the capital asset pricing model, which is a very regularly asked part in the examination. So first we discuss about risk return profile. When you see a security, financial instrument, you want to know two things about it before you go for investment. What is the return expected from that particular investment? Number two, what is the risk of that return? The expected return, we call it as average return, whether it is scenario analysis or past historical analysis. The word expected return means average return. It may be simple average if I go for the past data. It can be weighted average if I understand the return through scenario analysis. The risk of a security is its standard deviation. Standard deviation of x is equal to square root of sigma x minus x power the whole square divided by n. Next, when you find out the return and risk using a sample data, in that case the standard deviation formula changes to square root of sigma x minus x power the whole square divided by n minus 1. We discussed in the previous class. Number 2. In case of probability, sigma x is equal to square root of sigma p into x minus x power the whole square. How a single security can have a risk as well as a return. A group of securities or a portfolio of assets may also be having a return as well as risk. Return of a portfolio is the weighted average return of the individual securities inside the portfolio. Risk of a portfolio is square root of W1 square sigma x square plus W2 square sigma y square plus 2W1 W2 sigma x sigma y correlation of x and y. Square root gives you the standard deviation of portfolio. The formula has three influencing factors: risk of the individual securities, the proportion in which I am investing, importantly co-movements. So co-movement is measured through correlation coefficient, which can range from -1 to +1. -1 means perfectly correlator, perfect negative correlation, plus 1 means perfect positive correlation. When correlation is minus 1, I can get the maximum benefit through diversification. Plus 1, no benefit can be obtained through diversification. Minus 1 correlation, sigma p becomes W1 sigma x minus W2 sigma y. Plus 1 becomes W1 sigma x plus W2 sigma y. Earlier we discussed with minus 1 correlation, this can even be reduced to 0, having a proper proportion. Proportion of x is equal to sigma y by sigma x plus sigma y. Proportion of y is equal to sigma x by sigma x plus sigma y. Correlation is found out using the formula covariance of x and y divided by sigma x into sigma y. Then we saw our 3 security portfolio. The sigma p becomes W1 square sigma x square plus W2 square sigma y square plus W3 square sigma z square plus 2 W1 W2 sigma x sigma y correlation of x and y plus 2 W1 W3 sigma x sigma z correlation of x and z plus 2 W2 W3 sigma y sigma z correlation of y and z, the square root. Like that, for n security portfolio we will be having n square terms, n variance terms, n into n minus 1 covariance term. As the number of security increases, individual security risk becomes insignificant, their common becomes very important. Then we discuss about the Markowitz theory. In a low risk, low return portfolio, if we inject a high risk, high return security, the return increases but the risk may decrease due to the correlation coefficient. But the decrease in risk will not be forever. After some time, return also increases, risk also increases. The curve moves leftwards, upwards, and then take a right turn. The leftmost point on the curve we call as minimum variance portfolio. For a correlation not minus 1, minimum variance portfolio is proportion of A is equal to sigma B squared minus sigma A sigma B correlation of A and B divided by sigma A squared plus sigma B squared minus 2 sigma A sigma B into correlation of A and B. Like that one can find out for proportion of B. Now, we just from minimum variance portfolio, the curve will become an efficiency frontier. What Markowitz says that we have to invest the money only in the efficiency frontier, which consists of portfolios which are efficient portfolio. What is an efficient portfolio? If there exists no other portfolio that gives higher return for a lower risk, higher return for a same risk, same return for a lower risk. Now, in that efficiency frontier, where to invest depends on the investor's preferences, for which we use a utility curve where we had something called as risk aversion. Investors are classified into 3 types: risk lovers, risk neutral, and risk averse investor. Risk lovers like to pay money even to take the risk just for the sake of excitement. Risk averse as a risk neutral will be indifferent towards risk or no risk. But risk averse doesn't want to take risk. If you want him to take risk, we will ask for a premium. All investors are assumed to be risk averse investor. In that case, every investor will be having a utility curve. It depends on its risk aversion factor called as A. The curve formula is given by utility is equal to expected return plus expected return minus half into A into sigma security the whole square. That gives you the utility. Put the utility curve into the efficiency frontier. Point of tangency will be the efficient portfolio as per Markowitz. But we disputed that by saying that we can even combine risk-free asset. When asset is combined with the efficient portfolios in the share market, then we'll be having a line of tangency, which is called as capital allocation line. Either invest the entire money in the risk-free asset or in the point of tangency or in their combination or borrow and invest. In all these cases, we'll be having a efficiency frontier called as capital allocation line. In that, the return of a capital allocation line is WRF RF plus WS RS. And the risk of the capital allocation line portfolio is sigma P is equal to WS sigma S. Then we did some problem also regarding the capital allocation line. We further said that if all investors have the same efficiency frontier, same expectation, everybody will be investing in the same capital asset. So it becomes from CAL to CML, capital market line. where there is a portfolio called as market portfolio, in which all the investors will be investing. That is having a return as well as risk. The return on market portfolio is called as RM. The risk is called as sigma M, and this is measured through the index movement. The market portfolio prices are represented by the change in index. So the return of the market portfolio is year-end index minus year-beginning index divided by year-beginning index plus dividend yield reported by the stock exchange and so on. And then we discuss about the next area called as capital market line. Before that, in security market line, we have the formula return of portfolio RP is equal to RF plus sigma P by sigma M into RM minus RF. Then we discuss about CAPM. CAPM says that risk can never be reduced to zero. There is still some risk that cannot be reduced even if you go for full diversification. That is called as systematic risk or non-diversifiable risk. So this called of two types, systematic, unsystematic. Unsystematic risk are company specific, can be diversified away. Systematic risk are in the system itself common to all the companies, cannot be diversified away. Here the systematic risk examples are all risk coming out of the macroeconomic factors. Unsystematic risk is the risk that is company specific, like litigations against the company, product profile, etc. etc. Then we saw that a person should ask premium only for the systematic risk. He should not ask premium for the unsystematic, because unsystematic risk can be diversified away. So CAPM gave an equation called as SML. Tell me what is SML? KE is equal to RM plus beta into RM minus RM. Any investor wants minimum what return? Risk-free return. But for taking a risk, he wants a premium. If he invests in market portfolio, what is the premium he wants? RM minus RM. That is the equilibrium premium he called. Yes or no? So for taking the company risk, what premium he wants? Beta times RM minus RM. What is beta? Beta measures risk. A beta of 2 times means if the market portfolio return changes by 1%, the security return changes by 2%. High beta stocks are having more than 1 beta, low beta stocks less than 1. Equilibrium beta stock is equal to 1. This beta can be calculated in 3 ways at present, namely change in security return divided by change in market return. The second way is sigma S by sigma M into correlation of S and M. Third is covariance of security and market divided by sigma M the whole square. Now this SML and CML, how they are different? In CML the equation is RF plus sigma P by sigma M into RM minus RF. Here it is RF plus sigma S by sigma M into correlation of S and M into RM minus RM. Only extra term in SML is what? Correlation. Because I don't ask the premium for the entire sigma S. I want the premium only for that sigma S which is correlated to the market movement. Is the next issue we discuss. Right or not? Next. Then we discuss about underpricing or overpricing. You for any security, we have to find out SMLKE, that is RF plus beta into RM minus RF. For the market portfolio, if I want so much return, for this sigma S, what should be the return I should be asking? Find out the equilibrium discount rate. Using that value, the share with this present value of the future benefit. Most of the examinations, we value that share using D1 by KE minus E formula. What we get, we call as fair price. This we compare with what price? Market price. If market price is more than the fair price, then the market is overpricing it. Market price is less than fair price. Market is underpricing it. Other way of understanding is you find out the SMLKE, that is your required return, yes or no. Also find out the expected return. Expected return may be past average or future scenario based. Of our given market price, find out KE is equal to D1 by P0 plus G. The expected return is what you believe the share will be giving, and required is what you know the share should be giving. If what share is giving is more than what should be giving, share is a good share. Expected return more than the SML return, share is underpriced. Expected return less than SML return, share is overpriced. Is equal to means equilibrium pricing is what we discuss in this chapter till now. Everybody yes or no? I made a very quick summary, fast. That itself took so much time. Now, chapter is only halfway through. We are having what? Short single index, arbitrage, and then what? Efficient marketing personnel, other half is there. But this is such a chapter, it's a very big chapter. Now, the reason it is big is because it is not a chapter, it is a subject. This is what a subject in its own right. In most of the MBA courses, they have 100 marks paper for what? Portfolio management itself. We try to condense it and what? Discuss as crisp as possible. Condensation, it is so much. I cannot reduce it further. Everybody following up now. Can I go to the next stage? Now. Take question number 15. Now, we are doing the CAPM sums. Yes or no? Now, in which, now let us continue with the problems. Today also, you need not worry too much. I am not going to burden you with lot of words. We are going to only do deeds only. By doing what? Lot of problems. Can I proceed? Take question number 15. See, during these phases of classes only, you should be helping me to move the portions faster, because I cannot explain faster. I don't want to explain faster. I have to explain only what slowly. I may repeat my explanation. But sums can be done faster, because this is your writing speed, calculating and telling. If you are agile, I am also what? Very happy, and I will be moving faster problems. All of you involve yourself, participate and do the calculations. Take question number 15, please. An investment advisor, first of all, is mic audible to everybody? Is okay or not? No. I think yesterday there was a problem in mic, na? Yes, okay. No. An investment advisor has been monitoring the equity share of Spicy Food Limited, SFL, over the past 1 year. On the basis of his assessment of the fundamentals of the company and his expectations on the stock market conditions during the next 6 months, he has provided the following projections. Tell me, is he a lazy investor looking at past, or this advisor is a very productive person based on future estimations? He is doing historical analysis or scenario analysis? Scenario analysis. Now, next. There can be 1, 2, 3, 4, 5, 6 scenarios. Scenario 1 is having a probability of 10%. Scenario 2 having a probability of 15%. 3, 20, 4, 25, 5, 20%. And the scenario 6, 10%. These are all the 6 scenarios that may happen is what we believe, and is given a probability for those scenarios. Okay. If these scenarios happens, the SFL share is expected to give a return of 10%, 16%, 20, 26, 30, and then what? 36. Tell me, what is 26? If the scenario 4 happens, for which the probability is how much? 25%. He is saying that the company can report an earnings of how much percent? 26% on my investment. Response is or no? No. For all these scenarios, how he estimated what the company may give, same way he also estimated how the market portfolio will behave. He estimated the index also for the following scenarios. So all the 6 scenarios, the index return also has been given. Everybody following up? Now, next. You are required to calculate the following. Expected return and risk of SFL share, the expected return and risk of market index, the beta coefficient of SFL share. That's a question. It's an examination problem for 10 marks. Okay. Now, can we start doing the solution or not? Now, again, I just want to understand how all this happens. See. Person doing scenario analysis identifies various possible scenarios. Generally, most of the HSBC banks and other banks give projections for a country itself, yes or no? Based on the quarter 3 performance, what may happen in the next quarter, they give the projections for the country on base of different events. Okay, if the monsoon is proving to be what? Good. What is going to happen to the overall GDP or the index. If the monsoon is poor, what is going to happen? If the government changes, what is going to happen? If this government comes, what is going to happen? If Aam Aadmi becomes prime minister, what is going to be the effect on what? Stock market. Like that, different scenarios. It may be the weather, there is a monsoon, etc. It may be the government, it may be a recent parliament session where expected bills may be passed or what, may not be passed. Industry is affected by what? So many scenarios. For all the scenarios, what they do is they predict how the market will behave. That is what happens to the index point. All these are prediction how the market will behave, and they also predict how the given company share will prevail at a given market price. Because I cannot find the return without knowing a price or not. This is for a given market price. What is going to happen to the share return? For this, assign also what? Probability. This is what is referred to as scenario analysis. Everybody following up? Now, with this data, they ask you to find out, number one, expected return of the share. A share can have a return and risk or not? Yes. Share can have a return and risk. Market portfolio can have what? A return and risk. It or not. Now, what is the expected return of a share? From the SFL share, will I expect 36% or 10% or? No. I expect what? Average. What average? Weighted average. What the expected return of market index? 12 or 30 average. What average? Weighted average. Second question is, what is the beta coefficient? That is expected risk. The risk is nothing but what? Standard deviation. Tell me what is the formula for standard deviation? Square root of sigma p into s minus s bar the whole square. Here is going to be what? Square root of sigma p into m minus m bar the whole square. They also calculate what? Beta coefficient. What is the formula for beta? Covariance of security and market divided by sigma m the whole square. What is covariance of security and market? Sigma p into s minus s bar into m minus m bar, and divided by sigma m the whole square. Already we calculated sigma m squared gives you the beta. Response is or no? Last class we did the sum, and now we are doing the sum. Last class is based on past historical data. It is based on what? Scenario analysis. Beta calculation with probability. That is without probability. Everybody respond. Are you following up? Can you start doing the solution together? Let us start with the solution. Write down question number 15. Write question number 15. Shall we start or not? No. Okay. First write probability. We will all do it together. Also calculate. Don't copy from the slide. Do and tell me what is in the slide. Okay. First probability. What is the probability? 0.10. 10% means what? 0.10, 0.15, 0.20, 0.25. 0.20, 0.10. If your total probability always should be what? 1. Now all mutually exclusive events, total should be what? 1. Can I proceed? Next. Second term is what? The security, yes. I call SFL share as yes. What is return of yes expected for all these 6 scenarios? Tell me. 10, 16, 20, 26, 30 and then 36. 10, 16, 20, 26, 30 and then what? 36. Okay, written or not? Now. Below that write working note. Write down working note. Calculation of weighted average return of security. Calculation of weighted average return of security. Calculation of weighted average return of security. Bracket la S bar. Average is called as what? S bar na, it is mean. S bar. Bracket close. Now, right? S bar is equal to, let's do it together. S bar is equal to, tell me what into what? 0.10 into 10 plus, right along with me, 0.10 into 10 plus, next is what? 0.15 into 16 plus 0.20 into 20 plus 0.25 into 26 plus 0.20 into 30 plus 0.10 into 36. 0.10 into 36. I want you to do and tell me. Don't wait for my slide. You tell me what is the number here. How much here? 20.5. 20.5 here? 23.5. S bar is equal to 23.5. S bar is equal to 23.5. I think you are able to follow or not? Next. Right? In the main table, M. Right? Next what? M. What is S? What is M? Tell me. If I invest in the security, this is all the probable returns. What is M? It is also investment. Invest in one security, a market. Investment in what? A market portfolio. Which is always captured through what? Index. Can I proceed? No. How security has a price, market has got what? Index. That's the only change. Right? M. Tell me what is M return. Tell me what the market index return. 12, 16, 18, 22, 24, 30. 12, 16, 18, 22, 24 and then 30. 22, 24 and 30. Can I proceed or not? Next. Write down. Working out 2. Working out 2. Working out 2. Calculation of average return of market portfolio. Working out 2. Calculation of average return of market portfolio. Calculation of average return of market portfolio. Calculation of average return of market portfolio. In bracket write what? M bar. It is nothing but what? M bar. Write down. M bar is equal to, write out M bar is equal to 0.1 into 12 plus 0.1 into 12 plus 0.15 into 16 plus 0.20 into 18 plus 0.25 into 22 plus 0.20 into 24 plus 0.10 into 30. 0.10 into 30. What's the number here? 20.5. 20.5. The average return of the market index is 20.5. Had invested in all the securities in the market portfolio in the given proportion, I don't know how much, 20.5 is I expect a return. Can I proceed or not? No. Next item is what? S minus S bar. All of you do along with me. S minus S bar. Tell me, 10 minus 23.5, what is the number? Minus 13.5. Sign important or not? Yes, it is important for covariance. Okay. 16 minus 23.5 minus 7.5. 20 minus 23.5 minus 3.5. 26 minus 23.5, 2.5. 30 minus 23.5, 6.5. 36 minus 23.5, 12.5. 12.5. Now, what will be the total of S minus S bar? It will not be 0. It will not be 0. The weighted total will be 0. Can I proceed further? Now. Next. M minus M bar. M minus M bar. 12 minus 20.5 minus 8.5. 12 minus 20.5 minus 8.5. 16 minus 20.5 minus 4.5. 18 minus 20.5 minus 2.5. 22 minus 20.5, 1.5. 24 minus 20.5, 3.5. 30 minus 20.5, it is 9.5. Is M minus M bar. Shall I proceed or not? Next. P into S minus S bar into M minus M bar. Tell me why I am doing this calculation to find out what? Covariance. Okay. Now, 0.1 into 10 into 12. Field for the numbers. When you calculate, will be knowing the field. Okay. 0.1 into 10 into 12. So, 0.1 into minus 13.5 into minus 8.5. Sorry. Tell me what is the number here? 11.475. 0.1 into minus 13.5 into minus 8.5 gives you 11.475. Next, multiply and tell me, don't wait for me please. 0.15 into minus 7.5 into minus 4.5. Multiply and tell me what's the number? 5.063. That's 5.063. 0.2 into minus 3.5 into minus 2.5. What's the number I'm going to get? 1.750. 1.750. 0.25 into 2.5 into 1.5. Tell me the number is how much? 0.938. Okay, 0.938. Next. 0.2 into 6.5 into 3.5. What is the number? 4.550. 4.55. 0.1 into 12.5 into 9.5 is equal to how much it is? 11.875. Getting it or not? Don't look at the slide and tell here. Tell and then put the slide. 11.875. Okay. Don't read like a news. Can I proceed? Now, if I total, I will not total unless I hear from everybody. Everybody will be the total. 35.651. 35.651. Don't think I am very childish asking you to do what is on your slide here. You have to get a feel or say first hand information how it is being done. Right or not? Next, please. P into S minus S bar the whole square. Tell me why I am doing this. To find out the standard deviation of the security. Correct? Covariance of P into S minus S bar into M minus M bar. Why I am saying P into S minus S bar the whole square? To find out the standard deviation of the security, because the question asks you the same. Right or not? Now, 13.5 into 13.5 into 0.1. Tell me what is P into S minus S bar the whole square? 18.225. 18.225. Everybody, even if you don't do, at least tell and write. What you will do? What into what into what? 7.5 into 7.5 into 0.15. 3.5 squared into 0.20. 8.438, 2.450. 2.450. Tell me the next number. What? 2.5 the whole squared into 0.25. 2.5 into 2.5 into 0.25. What's the number? 1.563. 1.563. Next number, 6.5 into 6.5 into 0.2. 6.5 into 6.5 into 0.2. The number is what? 8.450. 8.450. Last number, 12.5 squared into 0.1. What is the number? 15.625. 15.625. If I total, I will be getting a number 54.75. Total is 54.75. Okay. Now, don't write. What is 35.651? Sigma P into S minus S bar into M minus M bar. What is this 54.75? Sigma P into S minus S bar the whole square. Can I proceed? Now, third, last column is what? P into M minus M bar the whole square. P into M minus M bar the whole square. P into M minus M bar the whole square. 0.1 into 8.5 squared. 0.1 into 8.5 squared. What is the number? 7.225. 7.225. 0.15 into 4.5 squared. What is the number? 3.038. 3.038. 0.20 into 2.5 squared. What is the number? 1.250. 1.250. 0.25 into 1.5 square. 0.25 into 1.5 square. The number is how much? 0.563. 0.563. 0.20 into 3.5 square. 0.20 into 3.5 square. What is the number? 2.450. Number is 2.450. 0.1 into 9.5 square. 0.1 into 9.5 square. What is the number here? 9.025. Number is 9.025. What is the number total here? 23.65. The total is 23.65. Good morning, India. 23.55. Can I proceed or not? No. Shall I proceed or not? No. Everything has been computed. Can you go for the next stage? Now, right now. Standard deviation of security. Right now. Sigma S. So we can call the first step as computation table. All things has been done. Okay. Step 2. Standard deviation of security. Sigma S. Standard deviation of security. Sigma S. Can I proceed or not? Now. Everything ready-made available. What is sigma S? Square root of sigma P into S minus S for the whole square. Square root of sigma P into S minus S for the whole square. Can look at the previous table and tell me what is sigma P into S minus S for the whole square? 54.75. Simply square root of 54.75. Square root of 54.75. How much going to be here? 7.4% is equal to 7.4%. Is equal to 7.4%. Respond yes or no now. Next. Step 2 or step 3? Step 3. Standard deviation of market portfolio. Step 3. Standard deviation of market portfolio. Standard deviation of market portfolio. Formula square root of sigma P into M minus M bar the whole square. Square root of sigma P into M minus M bar the whole square. Sigma P into M minus M bar the whole square. Can I proceed? Put the numbers here. It is square root of, tell me what is M minus M bar the whole square? 23.55. Square root of 23.55 is equal to how much standard deviation of market? 4.85. Market standard deviation is 4.85. It is 4.85. Please tell me, are you following or not? Next. Step 3 or step 4? Step 4. Calculation of beta. Step 4. Calculation of beta. Step 4. Calculation of beta. Underline that. First write the formula, then we can just start doing it. What is the formula? Beta is equal to covariance of security and market. Right. Beta is equal to covariance of security and market divided by what? Sigma M the whole square. Covariance of security and market divided by sigma M the whole square. Covariance of security and market divided by sigma M the whole square. Respond yes or no? No. Write down. Covariance of security and market is equal to covariance of S and M. Security and market is equal to covariance of security and market is equal to, tell me the formula substitution. What is that? That is sigma P into S minus S bar into M minus M bar. Sigma P into S minus S bar into M minus M bar. Should we calculate this? Already calculated. Already calculated. Look at the first table and tell me what is P into S minus S bar M minus M bar? 35.651. The covariance is 35.651. 35.651. Respond yes or no now. Beta is equal to, we already written the formula, only write it once again. Beta is equal to 35.651 divided by, beta is equal to 35.651 divided by, what is sigma M? Last slide, 4.85. So 35.651 divided by 4.85 square. 35.651 divided by 4.85 square. Tell me what is beta number? 1.52 times. Is equal to 1.52 times. The meaning is SFL share is 1.52 times riskier than what? Market is the meaning. Okay, beta is 1.52 times. Beta is 1.52 times. Respond yes or no. For this problem, I think it is 9 marks or 10 marks, I don't exactly remember. Is it worth or not worth? Nothing there. You just have to substitute what? Numbers and then do the calculation. One need to know these formulas, and for doing the hard work of doing what? Calculations, the mark has been given. Can I proceed further? No. Please. Shh. See. Even let's see the summary of the answer. Let's write down and then go for one small discussion. Okay, write down. Final solution. We have to answer the questions now. Final solution. Final solution. Part A. Part A question asks you to understand the market share. Part A, we are going to understand the share. Expected return of SFL. Part A, expected return of SFL. Based on their past performance, how much can I expect from it? 80% return? No. Can I expect how much return? 23.5. The word expected return generally can be used to indicate an average return, 23.5. Is the 23.5 100% sure return? No. It is having what? Standard deviation. Risk of SFL share. Risk of SFL share. What is risk of SFL share? 7.4%. Risk of SFL share 7.4%. Stop writing and tell me this is the total risk of the security. Yeah? Systematic risk. The represents what? Total. This risk is both systematic as well as what? Unsystematic. It represents the total. There is a variation of the expected return. That's all. It represents what? Total risk. Later in, let's say, next second class from now, I'll discuss a concept called a sharp single index model, where I'll be breaking the 7.4% into how much is systematic risk, how much is unsystematic risk using regression analysis. Everybody following order. There's one step ahead we'll be discussing in the next stage. Can I proceed? Now, at present we should know that the 7.4 represents what? Total return. Say total risk. It consists of both risk due to system as well as what? Company specific risk. Enough for it or not? Now, next is part B. Next is part B. How I want to understand the security, I want to understand the market portfolio, so no. How security can have a risk and return, the portfolio too can have what? Risk and return. The expected return of market. Expected return of market. What is the expected return of market portfolio? 20.5. The expected return of market 20.5. What is the risk of market here? Risk of market is 4.85%. Expected return of market 20.5. Risk of market is 4.85%. 4.85%. Okay. I know about the security now. I know about what? Market. I should know them together, right or not? That is called as what? Beta. Part C is what? Beta. How risky the security compared to market? Yes, you are right. What the beta it is? 1.52 times. Beta is equal to 1.52 times. Beta is equal to 1.52 times. Okay, now, see, I want to have a understanding of what is happening in this theory. So again, not required by the question, but we voluntarily do it just to have more clarity. Can I proceed? Now, see. I put a question to you directly, you answer me. First answer based on Markowitz. Based on Markowitz, I have two investments to make. I can either invest in the security, I can invest in a portfolio. The portfolio called as what? Market portfolio or a fully diversified portfolio. Respond, yes or no? No. You tell me, if I invest in the share, SFL share, I expect to earn how much return? 23.5. What is the risk? Okay. No, I don't want to invest in a security. I'll invest in what? Portfolio. The portfolio consists of 2 shares or 3 shares or entire market. We call it as a market portfolio. So no. So if I invest in the market portfolio, what is the expected return? What is the risk? Tell me, which is good? Investing in the share or market portfolio? Answer as per Markowitz. Answer as per what? Markowitz. Which is good? Share or market portfolio? Both are what? Good. Both are efficient. Share gives more return for more risk. Market gives what? More return for less return for less risk. Both are efficient. Only my security also efficient. Market model also is what? Efficient. If it is a curve, it's going to be efficiency frontier as per the Markowitz. For return. But there will exist another asset called as what? Risk-free asset, which will make this curve as a straight line or not. The efficiency frontier changes. It changes in CAL. It changes in what? CML. Also what? SML. All the three are straight line. CAL, it is security and what? Risk-free asset. In CML, it is risk-based on what? Market portfolio. It will be used as a benchmark for evaluation. Yes or no? In SML, that also will be only for what? Correlation coefficient risk premium. Right or not? In this problem, I am going to use CAL. Leave it here. CAL is only a work in progress. CML versus SML only. Always is a discussion. Right or not? Now, The question did not ask you all those because they did not give you a risk-free return. So no. If I want to answer that question, I should know what? A government of India bonds return to just go for the comparison, right or not? Now, can we assume a risk-free return and then do a further calculation or not? Just to understand or observe what is happening. Everybody, can I proceed now? Right now, let us assume, I don't know how the numbers will come out. Now, just afterthought, I am giving it. It may be good or bad. Okay, I don't know about SFM, still suspense only. Okay, let us assume risk-free return to be, 10%. Can we have it or not? Let us have it. Let us assume risk-free return to be what? 10%. Let us assume risk-free return to be 10%. Okay. Now, can we start doing the calculation first? The correct way to calculate is SML. It should be what? SML. Write down SML. Security market line. KE is equal to formula is what? RF plus beta into RM minus RF. Can I proceed now? What is RF here? 10 plus beta is how many times? 1.52 into what is the expected market portfolio? 20.5 minus 10. 20.5 minus 10. Tell me it is 10 plus what is 1.52 into 10.5? What is the number here? 15.96. Tell me, is how much here? 25.96. Now, we can come to CML and later. First, let us understand properly what SML says. Let us understand properly what SML says. Anybody having the scalar? What is 10% risk-free return? Okay, this is what? Market portfolio. Right or not? No. See, the return on market portfolio is how much percent? 20.5. This is 20.5%. Understood or not? Now, this is having a beta of what? 1. Can I proceed or not? No. See, what the SML says is, if for a 1 beta, you want a return how much? 20.5%. My security, SFL security, based on the relationship, we found the beta to be how much? 1.52. So can I say beta is equal to 1.52. Can I have it here or not? So it is beta is equal to what? 1.52. For this, the return should be somewhere what? It should be somewhere here. Ennappa, right or not? So this should be the equilibrium, say, return for a beta is equal to what? 1.52. Everybody, are you following or not? No side comments. Can I go sit? Okay. Now, this should be for security. Yes. Security, yes. Tell me, it should be how much return here? 25.96. The security should be giving me how much return? 25.96. For beta is equal to what? 1.52. Everybody understood or not? Now, look at our slide and tell me, based on the past history, I believe that this will give me only how much percent? 23.5. That is, For me, the evidence is that the security will not be giving me how much? 25.96. When I see the scenario analysis or the past data anywhere, I expect the return of the security to be only how much percent? 23.5. It is somewhere here. What is 23.5? What is somewhere here? This is what is the expected return. Yes or no? Expected return is 23.5. SML return is what? 25.9. Tell me, is this security lying on the efficiency frontier or not lying on? Not lying. It is lying above or below or below. Is it a good security or bad buy? It's a bad buy because I should have got what? 25.96. I am not getting. Yes or no? As per Markowitz, as per Markowitz, this is having less risk. We take what? Less return. It is having what? More risk. We take what? More risk. But SML is more scientific because for this risk, if they are giving what? This much return, then for this risk, they should have given what? So much return. Otherwise, we are going and investing in what? Risky asset. Because comparing RF had made my entire decision making very simple. Yes or no? Now, so as per Marco, if you ask Markowitz, he'll say invest in market portfolio or invest in what? The SFM share, both are what? Equally good. Why is they both equally good? Because both are not inefficient to each other. Is what we said. Because for him the efficiency frontier is the risky asset portfolio. That is going to be Markowitz efficiency frontier. Yes or no? But now SML and all, it has become what? A straight line where risk-free asset is combined. Enna parameter na? They are combined what? Risk-free asset. In such a case, is this security efficient or not? Is found using what? The SML. As per SML, I should not invest in this security because for this security is beta 1.5 beta. I should be asking how much return? Because for a market beta 1, if the market is giving 20.5, market is put as a benchmark, this should be giving how much? 25.96. And here an assumption is the market line is efficient. Either efficiency frontier, market is assumed to be what? Efficient. Either we call as efficient market hypothesis. What is efficient market hypothesis? We believe the market is efficient and the SML market line is what? Efficient. So if market is giving this return, security market line, the security to market should be giving only what? This return should be lying on that line, but the actual return is what? Lying below that line. It is lying below efficiency frontier. Don't invest is the answer for this. Can I proceed further? Now. So the security gives me only how much expected return? 23.5, but it should have given me 25.96 for this risk. So I will be rejecting this particular SFL share for investment. Point number 1, accepted. Can I proceed now further? Now, point number 2 is, if the same thing is done by what? CML. I don't write beta here, I write sigma here. Now, beta is that portion of risk related to market. And I write what? Sigma here and then do it. Enna for it or not? Now, in that case, can I do the same problem using CML or not? Now, I forgot the formula for CML. You tell me. First, I'll settle down, then you tell me. CML is equal to what the formula? I can say RS. In security, no? Return of a security. If I invest in portfolio, it becomes what? RP. But return of a security is nothing but what? RF plus sigma S by sigma M into RM minus RM. Only thing is correlation is missing. In that case, tell me, what is R of everybody? 10 plus. Look at the notebook. What standard of security? 7.4. What market standard deviation? 4.85. What is RM minus RF? 20.5 minus 10. Are you all sleeping awake? Good morning, friends. What is RM? What is 20.5? Market portfolios return. What is 10? Return of the risk-free asset. Okay. And this is 7.4 is sigma S by what? Sigma M into 10. 10, what is the number here? It is, first tell me, 10 plus, what is this number? 16.02 is equal to how much? 26.02. 10 plus 16.02 is equal to 26.02. Now, I have a doubt. Here, I expect only 25.96. And expect what? 26.02. Why is CML greedy? It is expecting more. Why is it expecting more? It requires more because it does not ask the premium only for the systematic risk. It also for ask for what? Unsystematic risk. Hence the required return becomes more. Everybody, are you follow what I am saying? So, This is the first stage. This becomes what? Second stage. Inga romba simple, yeah. For taking this 4.85 risk, for taking this what? 4.85 risk, the market is giving me a premium of 10.5%. For taking a 4.85 risk, if the market is giving a premium of 10.5%, for taking how much risk? 7.4 risk, the market should have given me how much premium? 16.02, plus the risk-free investment how much? 10. I should be earning how much? 26.02, but unfortunately the SFL is expected to give only how much? 23.5. It is falling in capital market line or below capital market line? Below capital market line. Respond yes or no. What a change. Instead of measuring the risk as beta, I measure risk as what? Sigma. That's the only change. Everybody are you understanding or not? I'm again saying only to show what? Differentiation stage by stage. Up to this, are you following up? With this, the problem stands completed. Now, if you see what happened, Markowitz says both security market, both are what? Equally good. Why Markowitz says both are equally good? Because one is high return, high risk, and is what? Low return, low risk. He does not see for this risk, is the return sufficient? Are you following what I'm saying? He only compares absolutely the risk and what? Return. His efficiency frontier is a curve. That is called as Markowitz efficiency frontier. Yes or no? What is bad about that efficiency frontier? He does not concern another market called discovery market, where some base return is anyhow earned without taking a risk. Yes or no? In that case, what concerns two markets here? It is CAL, CML, SML. All the three concerns what? Both the markets. The risky asset and then what? Discovery asset. In that, which is better? CML is better than what? CAL due to its implementability. Yes or no? And SML is better than what? CML because they say ask the return only for what? Systematic risk. Ultimately, the ultimate model to be used is what? CAP. That is why in today's world, CAP means what? Widely used in spite of lot of criticism about the assumptions. Are you following what I'm saying? That advanced is also came. APT is more advanced than what? CAPM. But still, people are not using very popularly the arbitrage pricing theory. Till date, in any share market analysis, they always use only what? CAPM. Now, its supremacy has not yet been what? Undermined by any new theories. Everybody following or not? So, for that more empirical research, there are other issues and all not relevant for our exam preparation. Hence, I don't want to confuse you more. Are you following on? So, which is superior model here? CAPM compared to CML. APT is conceptually superior. I don't deny. APT is what? Very good conceptually superior. But people find it difficult to what? Apply it due to the ease in application, convenience. Even a child can understand this equation SML. It's very, very simple equation that makes CML very, very popular. Are you following now? So, did you understand this now? Right on. This I think I finished copying. This now finish copying or not? Now. If you want, you can copy this diagram also. Those are not copy, raise your hand. Copy it here. And this return is 23.5%. Finish copying. Only diagram, draw a line, dot, 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 two lines you have to have like that, and then do the calculation. Am I finished? Over. Next. CM. Hey, what happened here? Why you are shouting? Always don't be in a protesting mode. Be accommodative. Can I ever say? Write down next CML. Same problem using CML. Return of security is equal to, please, sigma s RF plus sigma s by sigma m into RM minus RF. Return of security is equal to RF plus sigma S by sigma M into Rm minus Rf. Don't talk, please. 10 plus 7.4 by 4.85 into 20.5 minus 10. 10 plus 7.4 by 4.85 into 20.5 minus 10 is equal to 10 plus 16.02, 26.02. Please, shh. 26.02. 26.02. Stop talking. Can I proceed or not? Now. If you want, you can also draw a small diagram for this CML. Please draw along with me. This is called as what? Market portfolio. Stop talking, please. If you all are alert, away, tell me what I should write here. Sigma M. What is the standard deviation of market? What is sigma M? Look at the workbook. How much? 4.85. Sigma M is 4.85. The standard deviation of market is 4.85. For a 4.85 risk, I am asking, or the market is giving how much return? 20.5. It gives a return of 20.5%. Enough or right or not? No. But for my security, I have a different standard deviation or not? No. What is the standard deviation of my security? Tell me what is standard deviation of security? Sigma S is equal to how much here? 7.4%. 7.4%. Now you should be telling me what is the return that is required. The required return as per the CML is how much here? 26.02. The required return should be 26.02. Now respond, yes or no? But for the 7.4 risk, the share is giving only what? 23.5. Somewhere here it is giving me the return how much percent? 23.5. It is falling on CML, below CML, below CML. If this is the efficiency frontier, the security is inefficient. Okay, now. It falls below CML. So this line is called as capital market line. This is called as risk-free 10%. Everybody, can I proceed or not? Write down conclusion. Write down conclusion, please. Finish copying up a conclusion. Number 1. Shall I proceed? Please. Never, don't draw art and all. Just draw a small diagram. Okay, now. Shall I proceed? Write down. Conclusion. Point number 1. As per Markowitz, both the share and market portfolio are equally good. As per Markowitz, both the share and market portfolio are equally good. As per Markowitz, both the share and market portfolio are equally good. Because market portfolio gives low return for low risk. Because market portfolio gives low return for low risk, and the share high return for high risk. And the share high return for high risk. And the share high return for high risk. This is true. This is true if we ignore. This is true if we ignore. If we ignore. What if we ignore here? If we ignore the risk-free market. This is true if we ignore the risk-free market and have efficiency frontier. This is true if we ignore risk-free market and have efficiency frontier purely based on risky assets. This is true if we ignore risk-free market and have efficiency frontier purely consisting of risky asset and have efficiency frontier purely consisting of risky assets. Did you all understand the first point or not? Next, point number 2. Point number 2. However, as per CML and SML, as per CML and SML, the SFL share is not good. As per CML and SML, the SFL share is not good. The SFL share is not good because the required return which is 25.96. Are you following? Which is 25.96 or 26.02. Both systems are calculated now, which is 25.96 or 26.02 is the required return is more than the expected return of 23.5. The required return is more than the expected return of 23.5. The required return is more than the expected return of 23.5. Respond everybody, are you following or not? So now, last point. Point number 2 or 3? 3. In SML, we want only how much percent? 25.96%. In SML, we want only 25.96% from the share. But in CML, we ask how much? 26.02. But in CML, we ask 26.02. Why? Tell me why we ask more. Write down. Because we require the risk premium for the entire risk. Because we require the risk premium for the entire risk in CML. Because we require the risk premium for the entire risk in CML. We require the risk premium for the entire risk in CML. Everybody, are you comfortable or not? Now, with this, we have completed this particular discussion. Can I proceed further? Now, see, based on this, just one observation and then we can go. Don't say I'm not allowing you to go further. Okay. See, whenever you hear the news about RBI cutting interest rate, RBI increasing interest rate, have you watched the share market news or not? If you watch carefully, green share market increasing, red means share market what? Decreasing. That's how they represent it. Okay, tell me, when the RBI cuts the interest rate, what about the share market prices? Tell me. RBI slashes interest rate 0.25% cut, rate cut, they say or not. When RBI reduces the interest rate, what about share market? Tell me. Share prices increase or decrease? Increase or decrease? Share price what? Increases. When the RBI cuts that is increases the interest rate, the share price what? Decreases. It is very simple because when RBI increases interest rate, the risk-free asset itself is giving more interest. So the corporate bonds or responsible gives you what? More interest. In that case, for the share to be on par with them, to have an efficiency frontier where the share should be going into them, they should also what? Decrease the price so that their investment also increases. When RBI increases the interest rate, two way of understanding it here. When RBI what? Increases interest rate, then risk-free asset gives you more interest. Suppose there's a risk-free asset giving you 25% interest, yeah, like invest in SFL share. Real fun what I'm saying. So when RBI increases the interest rate, what happens is the expected return KE also increases. That is RF increases, K is equal to what? RF plus beta into RF minus RF and so on. So what happens is, then the share price has to what? Decrease for them to cope up with what? The other angle. Are you following what I'm saying? Same way, if it is interest rate is what? Slash, then the share market is already at what? Higher price. They can reduce the price, still be in the SML. Are you following what I'm saying? This is one way of understanding it. Can I proceed further? Now, next. Can you just go for the other sums? With this, we complete solution to question number 15. Okay, now. Take question number 16, please. Once again, a past examination problem. Please. The following table gives an analyst expected return on two shares. Spelling mistake here. Stamp the two TW on two shares for a particular market returns. Market return may be put percentages here. Are you awake? Yes, sir. So market return may be 6%, 20%. Aggregation can give me 2%, 30%. And differences are 8%, 16%. What are the betas of the two shares? What is the expected return on each share if the market return is equally likely to be 6% or 20%? If the risk-free rate is 7% and that market return is equally likely to be 6%, sorry it is wrongly typed, 6% or 20%, what is the risk? Make this 5% or 6% or 20%, what is the SML? What are the alphas of the two shares? This is a question here. Okay. I am hearing voices. Stop talking. Can we start now? Let us understand the question in perspective before we start doing the solution. Okay. See, I am looking at three investments. How many investments here? Three investments. Can you name the three investments? Investment in market portfolio, investment in aggressive share, investment in defensive share. Three assets I am looking at it. It's not no. In a market also is a portfolio only. Everybody understood what I am saying? So now let us see what happens. I do a scenario analysis. Okay. See, there can be a depression. Just I am taking two situations. There can be what? A recession or a depression. There can be what? A boom in the market. Better not now. Shall I proceed now? Okay, it is boom, that is understood. Okay, now what is so great about boom? Can I proceed? Now, depression and then what? Boom. First of all, if there is a recession in the economy, how the market performs? Market is expected to give me how much return? 6%. If suppose the economy revised, performs exceedingly well, I don't want to use the word boom, it performs what? Exceedingly well. Now understood or not? Tell me, what is the percentage return here? 20%. Now, in the two situations, please stop. In the two situations, what aggressive share is expected to perform? Perform at what? 2% or 30%. Defensive share at 8% and then 16%. And the second part of the question is said there's an equal chance 50%, 50% for what? These two scenarios to happen. Respond. Are you following on? Now, this is the question given here. Now, the question is calculate beta for aggressive share, calculate beta for defensive share. Tell me how many formulas we know for calculating beta? 3 formulas. What 3 formulas? Change in security return divided by change in market return. Second is what? Sigma SAS by sigma M into correlation of S and M. Covariance of S and M divided by sigma M the whole square. Yes or no? Now, that is the remaining two, second and third formula will be used when have more than 2 data. So, when have what? More than 2 data. Have more than 2, only 2, depression and then what? Boom. In that case, I can use the first formula or not? No. Graphically through regression, understand all the 3 formulas in the single index model. Only 2 data given. They also calculate what? Beta. Simply calculate beta as what? Change in security return divided by change in market return. Simple definition. Now, market return can move from 6 to what? 20. How much percent? 14%. When I have a depression, the boom, economic scenario changing, yes or no? So the change in market return is 14%, yes or no? When the market moves by 14%, aggressive moves by how much percent? 28%. Is aggressive having a same risk as market? Riskier than market? Riskier than market. What is riskier? 2 times. The beta is equal to 2 times. Respond, yes or no? In case of defensive, when the market fluctuates by how much percent? 14%. The defensive moves only by how much percent? 6%. 8%. So it is going to be 8 by 14. It becomes a defensive stock. Everybody, are you following or not? Now, write down first. Have you all done the facts, sir? Write down facts first. Let's do it together. Let's do it together. Facts. Finish copying up. Please. Can I proceed? No. Next. First part is what? Part 1. Calculation of beta. We have 4 parts. We are going to answer one by one. Let us quickly do it. Part 1. Calculation of beta. Calculation of beta. Can do it together or not? Tell me the formula first. Beta is equal to, please, beta is equal to change in security return divided by change in market return. Beta is equal to change in security return divided by change in market return. Tell me which is equal to, what is change in security return for A? Beta A is equal to beta of aggressive stock is equal to what minus what divided by what minus what? Tell me. 30 minus 2 divided by 20 minus 6. 30 minus 2 divided by 20 minus 6. How many times? 2 times. Beta is equal to 2 times. Beta D, beta of defensive stock is equal to, beta of defensive stock is equal to what minus what divided by what minus what? 16 minus 8 divided by 20 minus 6. 16 minus 8 divided by 20 minus is equal to 0.57 times. Beta is equal to 0.57 times. Beta is equal to 0.57 times. Shall I proceed or not? Now, second question, part 2. Read the question. What is the expected return on each share if the market return is equal likely to be 6% or 20%? Now, depression may also happen. Boom may also happen. What is the probability for both? 50-50, equal chance. Can I proceed on? Now, tell me, from aggressive share, will I expect 2% or 30%? I expect what? Average. Simple average or weighted average? Both are same. Because probability is what? Same. It should be what? Same only. Anyhow, you can use simple or what? Weighted average here. Same you have to find out for what? Defensive stock. Can I proceed or not? Write down. Next step part 2. Write down part 2. Calculation of expected return. Calculation of expected return. We'll do it together. Calculation of expected return. At first, aggressive share. So the word expected means what? Weighted average return, yes or no? First write situation, depression, boom. Depression, boom. Probability, what probability? 0.5, 0.5. Return, what is the return expected from aggressive share? It is 230. Weighted return 1 and then 15. Weighted return 1 and then 15. The expected return is how much percent? 16%. Defensive. Tell me, what are two situations? Depression, boom. Situation, depression, boom. What is the probability? 0.5, 0.5. The return for defensive is 8, 16. The weighted return is 4 and then 8. The expected return is 12%. Defensive expected return is 12%. We don't expect extremes. We expect what? Average. The word average should be weighted average, where the weights are the probabilities. In this problem, even if we calculate simple average, not an issue because the weights are same. Can I proceed or not? Next. Finish copying, huh? Okay. No. Those are not copy, raise your hand. Okay. Shall I proceed on? Please. Can I proceed? Now. Part 3. What is part 3? Risk-free rate is how much percent? 7%. Market return is equally likely to be 6% or 20%. What is SML? Enna parida not? Write down. Next. Part 3. Calculation of SML return. Calculation of SML return. Calculation of SML return. Before that, tell me the formula. What is SML return formula? K is equal to RF plus beta into RM minus RF. Ennappa, right or not? No. Let's discuss on that, right? Now, in that, do we have RF for the problem or not? Yes. What is the idea? 7%. Beta you have or not? Yes. Already calculated for aggressive as 2 times. Difference is what? 0.5 times. I have RF, I have what? Beta. But I should have RM or not? What is RM? Expected return of market portfolio. What is RM? Expected return of market portfolio. Will tell me market portfolio. I am expecting RM to be 20 or 6 average. Average. What average? Weighted average. Once again, respond yes or no. Write down. Next. In that right. Step 1. Step 1. Calculation of RM. Calculation of RM. Bracket la expected return of market portfolio. Calculation of RM. In bracket right, expected return of market portfolio. Expected return of market portfolio. Can I start or not? Write down. RM is equal to 0.5 into what is the return during this particular depression period? 6 plus 0.5 into or return during boom period 20. Tell me it is how much it is here? 13%. RM is equal to 13%. RM is equal to 13%. Respond yes or no? No. Write the formula. KE. Next step 2. Step 2. This is step 1. Write down step 2. SML return. Step 2. SML return. Underline that. Formula Ke is equal to what? Rf plus beta into Rm minus Rf. Rf plus beta into Rm minus Rf. Rf plus beta into Rm minus Rf. Can I proceed or not? Now we have to find out Ke for two shares, aggressive and then what? Defensive. Write down. Okay. Aggressive Ke is equal to 7 plus, what is 7? Rf. 7 plus 2 into 13 minus 7. 7 plus 2 into 13 minus 7. Rm is 13, 13 minus 7. How much percent? 19%. Is equal to 19%. Defensive Ke is equal to 7 plus 0.57 into 7 plus 0.57 into 13 minus 7. 7 plus 0.57 into 13 minus 7 is equal to how much percentage? 10.42 percentage. Is equal to 10.42 percentage.
Thank you friends. OMSAI Bhojanapalli.